Hello, everybody, and thanks for watching and the new update, the September update of Quadriga Stable Return. We are going to quickly through the presentation of the strategy investment process, and then go into the detail of September return and current positioning. So in terms of our investment philosophy, for us, the long-term success is not just about compounding capital during periods of positive markets return, but also to preserve capital during periods of volatility. And current situation is well known, but it's always useful to repeat it, is cash and money market and long-term fixed income instruments are their flow in terms of real returns are negative. The risk rewards of fixed income instruments is not attractive, and if we go into riskier type of assets like credit, investment grade, and high yield, investment grade especially is still very, very low spreads. So also very influenced by the movements of the yields, the treasury in the US and European yields in Europe. So the problem for investment grade essentially is a short inflation, and consequently is also short yield in a time where yields are all-time low. If we move more into riskier asset classes like public and private equity, we still have pockets of interesting opportunities where we can find decent risk rewards, but still other parts of the market are very expensive with valuation that don't make much sense. And of course, also in equity, as in credit, especially high yield, there is a problem of diversification. When there is an issue and there is forced liquidation, these two assets are the one who got hit. And we saw it in March 2020, either you had high yield or equity or also investment grade, you saw capital losses. You saw volatility in your P&L, and people, of course, care mostly. Usually what they did essentially is they sold and crystallized those losses. So our idea is how to participate in a market going up, in a bull market, but at the same time give the peace of mind if we can get through another March 2020, we will always be protected, and we don't force our clients to sell, to liquidate, because of course when crises come, it's more psychological than fundamental, and everybody remember what happened in March 2020. So our proposal is to switch from the classic asset allocation to behavioral allocation. The classic asset allocation says to you that you can be diversified and protected if you, besides equity, alongside equity, you invest into fixed income, let's say government bonds, credit, investment grade, and high yield. Through this diversification, you are fine. And it worked pretty well. The 60-40 balance fund has been very successful in the past 30 years or so. What's going on now? The power of diversification and the power of defense of the fixed income bucket, the government bonds plus some very high quality investment grade, is decreasing. First of all, in the fixed income space, the yields are so low that bond 10 years boom in March 2020 made just 3% when the DAX was down almost 40. And if you go to credit investment grade, first of all, very high quality credit is tough, hard to find. Balance sheets are not so solid, robust as they were years ago. So companies, also the average rating in investment grade is decreasing. If you're willing to find a very solid investment grade, you're gonna get anyway so low yield that at the end is same yield of the government bond, which is already very low. And the new risk coming here is not again COVID, it's not another pandemic. The new risk can be inflation. And inflation is the weak spot of fixed income and credit. So this 60-40 fund or strategy worked pretty well last year, still working decently this year. The hard job has been done by equity, which are up double digit, whilst fixed income is negative. So at the end, the 60-40 looks nice, it's positive, but the bulk of return, essentially all the returns, 100% of return comes from equity, whilst fixed income this year is losing. What happens if we have a combination of equity and fixed income down at the same time? So we want to switch from asset allocation to behavioral allocation, meaning that we pick not an asset, but a strategy. A strategy can be one asset long and the other asset short, can be in different asset classes like FX, credit, fixed income, commodities. And through this long and short, through this relative value, we can understand if, and then assessing the behavior of this single strategy across time, especially stress testing the strategy across stress scenarios, drawdown, a big drawdown in history, a potentially disruption in correlation. We assess if this strategy is a real defender strategy or is a strategy that is more a risk-on strategy. So it does well when the market is bullish. Or again, if the strategy doesn't have much correlation, doesn't care much about what happens to markets and fixed income, because it's a pure alpha, pure market neutral, then we have our bucket of pure alpha, uncorrelated alpha generation strategies. And for example, here how a risk-on strategy looks like, where the middle is zero, and on the right side, it's the maximum level for a risk-on strategy, which has a lot of positive beta factor, market beta factor. A defensive strategy is a mirror. It's a lot of defensive beta, defensive sensitivity, whilst zero sensitivity to market beta. And the uncorrelated strategy, it doesn't have any right or left exposure factor, is more on the pure alpha. So it has correlation to alpha factors. If we combine all together, what we want to achieve essentially is a strategy that has a bit of everything, but no excesses. Our purpose is then to create a strategy that is preserving capital, try to preserve capital during volatile times and making money during periods of, let's say, quieter periods for stock markets and traditional assets in general. If you look into the team, this fund is this strategy is a combination of all our talents we have internally at Quadriga. Diego Parino, Alfonso Torres, which some of you may know for the ENG fund. They are in charge of managing the risk, the tail risk, the strategy. So they are the, let's say, the goalkeeper of our team. And then we have all the team of RAW, which is an internal hedge fund we have here at Quadriga, been run for the past 12 years with amazing returns, 8% annualized in euro. Jose Mosquera and Jose Martin Vies are the two most senior people, plus they're alongside other 5 people in their team. They're all managing, they're all expert in credit rates, special situation in equity, and they're all managing the bucket of uncorrelated. And then we have Christian Thum, which is managing and long short internally at Quadriga, is also looking into the equity bucket. And then that's me doing more or less asset allocation, strategy allocation, risk monitoring, suggesting macro overlay to offset sudden risk we can get exposed through the different portfolio manager putting their own strategy in their own sleeves. This fund is everything has been going to be on has been in balance sheet. So all the different portfolio manager, they manage a sleeve, a pre-assigned sleeve, and they manage their own pre-assigned risk, and they put the trades in a stable return. And so what I do essentially, it's overview the entire portfolio trade by trade, and then of course I have divided all the trades by the PM and the type of strategy. Can be defensive strategy, uncorrelated strategies, or risk-on strategy. Here you can find the biography. I think we should go into more portfolio construction. The idea of this multi-asset, the 3 objectives we have is, first of all, capital preservation. As mentioned, for us, it's very important, a stable income, and inflation hedge. Our target is to make 5% in the medium to long term, annualized in euro. And the portfolio is composed in 3 building blocks. So we have the fixed income, let's say, MP3 assets, which for us are what we define as risk-on assets. MP3 is monetary policy free framework, which has been created by Ray Dalio, defining this new environment where both central banks and governments are willing to spend money and to act in a very expansive way. This type of monetary policy and fiscal policy will have some winner and loser, and we want to seek those winner and try to avoid the loser, of course. And that's what the risk-on strategy do in the MP3 asset bucket. Then we have the anti-bubble, anti-crisis bucket, which is managed by Diego Parina and Alfonso Torres, which is behave more like a put option. So the idea is they make good money trying to protect capital when things got ugly, and they try not to lose much money when the things go well for equity markets. And then we have the uncorrelated, the yellow dots. As you may see, they behave more as a normal distribution. So returns are more concentrated in the middle of the distribution, and they try to avoid the fake tails, of course, and they try to be also less volatile. And the combination of the 3 of them, it's a stable return. So let's go into the September update. There we are. Okay, September has been a tough month for us, and now we're gonna see the details. Overall, also fixed income in Europe, the investment grade suffered 1.1%, whilst a stable return suffered almost 2% losses, when bringing us back again negative 2% year to date. Still keeping a volatility of 4.6, and now we are 3% away from our target, long-term target of 5% plus inflation in Europe. So what happened during the month? Here we can see another chart where now we also, of course, down compared to the red line, which is the European investment grade. The blue line is stable return. The green line is a US Treasury. This month we had, we can see in here, the year to date, we had both NP3 assets and anti-bubble going down at the same time, whilst uncorrelated and our dollar exposure had positive returns, so contributed positively to the book. We started with 40% in equity in September, and the equity market was down around 4%, 4.2, the MIS award. So this contributed around 1.5% losses on the book. The anti-bubble didn't offset these losses. They also compound on these losses because they also had negative returns overall, the bucket for the month. So the combination of these two events, of course, for us, it's always our tail risk. We don't have a tail risk in case the market goes very negative. Our tail risk is more, let's say, anti-bubble and equity going down at the same time. So we know everybody equity was down 4.2. What happened to anti-bubble? Essentially, it has been yields. Our sensitivity to yields and to fixed income, although we don't have much of that, is pretty high. And this sensitivity comes from our big exposure to gold, which for us is one of our key defensive factors in our portfolio. If you want to pay the carry of being short equity, because anti-bubble needs to be always more or less short equity, negative beta on equity, this carry from time to time needs to be paid being long something. And this asset we chose to be long is gold. And unfortunately, last month, gold was down 3.5%. And this made the strategy, our defensive strategy, losing money and not helping us, but compounding on the losses of equity. So this has been the case for September. And we are going to see how the strategy looks like now, the new allocation. Just a quick macro overview. First of all, these are other two slides I put already in the last month update. We still have valuation, of course, all-time high. Spreads didn't move this month, although the volatility market was down 4%, spreads didn't move. The interesting thing I was looking at is a US curve. The 10-2 is now as steep as it was in 2016. It was interesting because after that, there's been a bull flattening, and this bull flattening has pushed at the end, the last few years, defensive assets like treasury and treasury course and gold, precious metal. So now we are in the point where, are we going to stop here in terms of steepening, or we're going to see continuous sell-off? The other things we are looking around in the economy and at the macro level, the supply is a kind of disrupted. I don't know if it means more inflation to come, surprise inflation. The Baltic Exchange Rate Index is the last 5 years of high level. And if you look at the short-term inflation expectation, the 3 to 2 years in the US and in Europe, we still we essentially recovered all the negative expectation with COVID, and now we are back to 2012, more or less 2012 levels in both in US and Europe. So inflation back to normal, inflation expectation going back to pretty high level compared to the last 12 years. Same time, on inflation, credit growth in US, for example, is not picking up. So if we had the picking up in credit in US after COVID, during and after COVID, of course, for also state, for the government, US government was pushing banks to lend money, and now this push, the government push in lending money, has finished, and the credit growth is kind of struggling. As many times, inflation, credit growth is one of the driver of also inflation, because it essentially is more money in the system. And so if you look at the velocity of money, it's still pretty low compared to historical terms. So our job is not now to say where to go. We are not essentially a macro fund. We are, let's say, in the multi-asset, we try to build the most robust portfolio in the multi-asset space using traditional asset classes. So we need to be prepared in the different scenario. In different scenarios, we need always to be prepared and to have the most robust portfolio. So I just put here a few scenarios we can foresee the next 10 years. It's going to be, again, a very, let's say, more inflationary scenario, but alongside a good economic growth. So this is not Goldilocks anymore, but still there is more inflation, but economic growth is higher in inflation. So essentially the economy is productive, and higher prices are accompanied by higher salaries, higher wages, and quality of life sustained, and everything goes well. So for us in this environment, you need to have equity value, because of course in this environment you should have higher rates. So it's preferable to have more value equity and some quality stock. Try to avoid the very long duration stocks. At least decrease a bit the exposure into your allocation, and try to buy every time you have a spike in yields. The growth stocks, they should suffer, like it happened in September, and then you should buy a bit the dip in those cases. But to a long-term allocation, it's preferable to have value equities. In terms of US curve, it's a classic bear steepening. Gold will suffer potentially because of the bear steepening, because of if the economic growth is above inflation, potentially the real rates are not going to be very negative as they are now. And in oil, as if, let's say, economic growth keep up, is a good proxy of economic activity, because the demand is not much on the supply disruption like it's happening now. It's going to be more on the demand side. The central scenario is the classic Goldilocks, the one we've been lived for the last 10 years or so, where essentially you have decent low average economic growth, no recession, neither amazing surprises in the economy, and inflation also keeps on balance between 1.5 and 2%. This Goldilocks, of course, and we already know the story because we've been lived here for the past 10 years. It's pretty good for equity growth. It's pretty bad for value stocks, and also quality stocks. They do very well. It's usually, of course, in the long term, it's more a bull flattening. So the 10 years goes down, and yields stay kind of low. The policy monetary yields rate stay low, whilst the long-term yields at the end they go down because there is demand. There is no inflation, normal inflation. The economic growth is not great. So besides equity and long duration equity like Nasdaq, institutional clients that also buy fixed income, which is fair, it's fine. And in this environment, gold should do well, because in this environment, real yields are supposed to stay kindly low. And when bull flattening happens, also the yields are going to be, the nominal yields are going to be lower. And so let's say the cost opportunity was switching from a fixed income instrument, a 10-year, 20-year treasury, which pays very low yields and negative, potentially 0 to negative real yields, into gold. It's fine. It's not very costly. And the oil in this environment, since the economic growth is not great, the demand of oil is going to be stable, no surprises. There can also be some less demand coming also from other technologies like renewable. So in this case, oil is not an asset that's going to shine. Stagflation is our first scenario, which is the one been talked about in the last month, has been kind of into the narrative of the market. In this case, you have a very low, depressed economic growth, but very high inflation. And in this case, my fear is equity is not gonna be great asset. Of course, between equities, I would prefer some quality and some value stocks, the one who can protect their pricing power and transfer the pricing power to clients without losing clients. So let's see what are the stocks in this type of environment, a tough environment. The last time we saw something like this was 70s and 80s. And what happens to other asset classes? Well, yield curves, they're flattening, because if you have zero economic growth and very dangerous inflation and people losing their quality of life, and quality of life declining for people also in the Western countries, what the governments, the central banks, what they're gonna try to do is try to fight this inflation, and the quick way is to increase rates. So that's they are flattening. So the short-term rates are gonna increase more than the long-term rates, and this is going to be very, very powerful for gold, this scenario. And at the same time, oil can be also powerful in terms of commodity. It's not just because inflation is also, it's a cause effect. Oil can be both in this environment, because oil and gas, they can be the trigger of higher inflation, and then because of the inflation, they stay high too. So the idea here is to these two commodities can do both well in this scenario, and they're only the two, let's say, asset classes that can really protect your portfolio. So what about our portfolio? So we are building the portfolio, try to have a mix of everything in order to be prepared in all the scenarios coming in the next 10 years. So of course we have 10% on gold, since 10% as allocation in terms of risk allocation in gold. But at the same time, we have a combination of US stocks and what is for us emerging market is kind of cyclical stocks. So the emerging market factor for us is more a cyclical type of stock. So we both have value stocks, some growth stocks, sensitivity, and gold. We don't have much oil sensitivity today, just tiny bit in the equity bucket. And this is the current allocation. We don't have much in fixed income in terms of allocation. Let's say in the last few months, the sensitivity that our quant models are giving us is we are essentially short fixed income now, because our equity bucket is short fixed income, whilst our anti-bubble bucket doesn't have any correlation or sensitivity to fixed income, whilst it still has good correlation to, and sensitivity, of course, to gold. So this is the, let's say, the macro picture, and this is the current portfolio today. We started the month still a bit aggressive with 44% in equity, but 30% in anti-bubble. Where in anti-bubble we have a mix of strategies. One of the strategies, also option strategy for us, are selling call and buy puts. We try to, if the market stays in a channel, we make money without negative carry. So we are very active there, and we now the weights of the option strategy is around 16% out of the 30, so half of that. And in the uncorrelated strategy, we have the same strategy as usual. The bucket is doing pretty well, and now it's 60%, which is a fine allocation for the volatility of the strategies. And in terms of equity, we are pretty diversified. We added emerging market finally. We have been zero invested the entire year, and last month in August, end of August, we added a bit of emerging market, and just to diversify the portfolio, and it was also an opportunity to invest in something that was down during the year, so more let's say upside potential. So that's the current situation. And of course, I'm a bit disappointed by the September return, which has been a combination of markets going down, which was fine after the entire year. All the months have been positive. There's been the second month in this year with a negative return, so which kind of expected. Unfortunately, our anti-bubble bucket didn't do well in terms of preserving capital, and so we couldn't protect the losses in the equity, and also we compounded a bit. So I know that it's a bit disappointing, but it's just very, very short term. Let's remember that our long-term view can display in a variety of ways, and we need to be prepared. We need to prepare for different scenarios, stagflation scenario, and this scenario that started a bit during a month, and then something like gold, which didn't work the entire year, can suddenly start working, and it's going to be a huge push for our portfolio. And it's something that gold and silver had very much outflow this year. Last year they did very well, 2019 they did very well, so 2021 was kind of expected not to be the top asset class, but there are much of the returns are sometimes are reverting, and gold is very, very attractive and is a good portion of our portfolio. So in another scenario where market is going to struggle with gold sustaining, or not, let's say, not losing money, but also making money in a down markets, this kind of scenario can trigger very, very positive returns for the fund. As a sum up, as usual, all these asset classes are open, and also we are launching the dollar and the pound share class. So happy to discuss one-to-one if you are interested in knowing more about the strategy, or talking to one of the portfolio manager. Thank you, and I will update. I will see you next month for the October update. Bye.